All right. Thanks for joining, everyone. We're going to get started in 2 minutes. Today's webinar is going to be on 5 end-of-year estate planning strategies. We're going to give people a couple of minutes to join. We've seen folks have joined. Please let us know if you can hear us. Put in the comments of where you're joining us from if you can hear us. I'm joining from New York. Peter's joining from warmer than New York, LA, I hope.
Definitely.
So. Okay, Princeton, New York, Austin. Can I get all over? New Hampshire. I'm wondering what's the warmest out of all of these places. Is it Austin?
No, Austin? Chandler might be the warmest.
You don't have much faith in LA.
Yeah, wow. LA's not that warm right now.
Chandler, high of 74. Perfect. We will get started in 1 more minute. Jathan's pitching Chandler for folks like me who don't handle the cold well. Get started. One more minute. Just letting people join. Okay, we're gonna get started. So first of all, really appreciate everyone taking the time to join. Folks kind of joining from all over. Today's webinar is going to be on 5 end-of-year estate tax planning strategies. So surprise to no one, end of year is coming up, and a lot of tax things are based on calendar year. So there's a lot of opportunities that really you kind of use it or lose it type of opportunities that you have to get done by the end of the year. So today's webinar is really going to be focused on what are those things really pertinent to gift and estate taxes that you can focus on. And so for a little context, this webinar is really for individuals and advisors, CPAs who work with clients who are facing gift and estate taxes today or are worried in the future they will be and want to take proactive action to mitigate that. For a little bit of context on Valur, if you're not familiar, Valur helps people understand, implement, and take advantage of tax mitigation strategies, whether it's reducing ordinary income taxes, capital gain taxes, or in this case, gift and estate taxes. Today's webinar is obviously going to be focused on the gift and estate tax, but we do have webinars every week, and our next couple of webinars are one's focused on ordinary income tax mitigation before the end of the year, and the following one's focused on capital gains tax mitigation. And just as a quick introduction, Peter, you want to give an introduction of yourself?
Yeah. So my name's Peter. I am a trust and estates attorney by background. I joined Valur from a law firm earlier this year, and I head up the estate planning and estate tax side of the business here. And yeah.
Perfect. I'm Monty. I founded Valur, and a lot of this was based on my own personal situation of I was fortunate to work for a startup that IPO'd and lived in California at the time, like a number of folks on the call. Really, my goal was, you always read stories about, whether it's the New York Times, ProPublica, there's always stories about how X billionaire legally reduces their taxes. And kind of my thesis was, if they're taking advantage of this, I should be able to too. One of the things I quickly learned is it's historically not been easy to, one, is even understand those solutions. It's expensive to understand them, then implement them, and then the kind of administration, you don't really get great quality. It's expensive, it's slow. And the thesis of Valur is, one, is how do we use technology to, one, make this accessible so that anyone can use the same kind of optimized strategies that a billionaire's family office uses, and use technology to make it accessible, a better experience, and more optimized. And so as part of that, we do free education, free calls. We have tools like calculators that help people understand the value of these structures. That's kind of the key piece of what we do. In today's webinar, as we mentioned, we're going to be really focused on what are end of year gift and estate tax focused strategies that you can focus on. And we're going to hit on what are those 5 and then kind of open it up for Q&A. During this webinar, please let us know if you have any questions in the chat box. If you have questions, we'll probably be able to address them. We'll either address them when it makes sense in the presentation or save them for the end, but we generally do address all of these. So let's get started. So let's start with the basics of, Peter, what is the annual exclusion?
Yeah, so I started to back up a little bit. It might make sense to give a little context on gift and estate tax for those of you who aren't super familiar. So the gift and estate tax, technically 2 different taxes, but essentially a single tax system. So the gift tax is a tax that applies to transfers that you make during your lifetime. So usually this is gifts to your kids or grandkids. It could be gifts to your friend or something, but usually gifts to kids or grandkids. The estate tax is similar idea, but it applies to transfers you make upon your death. So let's say you leave a bunch of money to your kids when you die. That could be subject to estate tax. The estate tax is a pretty high tax. It's 40%. So if you have $100 million, it's a $40 million tax. And a lot of states have their own estate taxes, especially sort of the high tax states like New York, in some of those other states, Massachusetts, that you might associate with higher taxes, although California doesn't have an estate tax. And so in some states, it can be up to a 52% effective estate tax rate. And so there's a couple of
just to take a quick pause there. So really, like, the key thing is the gift and estate tax is for people who are passing assets on to really anyone who's not their spouse, right?
Yeah, exactly. So you get a deduction for gifts to your spouse, and so basically
you have it unlimited, so you can pass on.
It's unlimited, yeah. So the transfer to the spouse isn't going to be a problem. But eventually the spouse is going to die, and then there'll be an estate tax problem then. So there's always eventually some kind of gift and estate tax issue, but there's no immediate issue if you leave something to your spouse.
Yeah, and the important piece of call out here, and this is where kind of mentioned up front of who this is for. This is people worried about the gift and estate tax. And it's important context that Peter's bringing up is this is a problem is if you're over the lifetime exemption, which is currently about roughly $14 million per person. As of law, it'll drop in half to about 7 million the start of 2026, unless the law passes. But a critical piece is, one is, for this to really be applicable, is you need to either have or expect to have over those amounts, and also want to pass those amounts on to, in most cases, future generations. If you plan to give it all to charity, it's not a concern. If you have less than that or aren't worried about having more than that, it's not a concern. If you have or expect to have more than that and want to pass it on to future generations, these are where these things are really important. Is that kind of
exactly. So there's sort of Monty alluded to it. There's two big exclusions besides the marital deduction and charitable deductions. There's sort of 2 big exclusions from the gift and estate tax. And so one of them is what Monty mentioned, which is the lifetime exemption amount. So each person, we'll talk a little bit about more of this. We'll talk a little bit more about this in a second, but each person gets a lifetime exemption from gift and estate tax. And so as long as you're below that exemption, you don't have to actually pay any taxes. And so the vast majority of people are below the exemption amount, which changes over time. It's currently $13.61 million per donor. The other big exclusion is the annual exclusion, which is the amount that you can gift to other people in any given calendar year without even using any of your lifetime exemption amount. And so in 2024, you can gift $18,000 to as many people as you want without using any of your lifetime exemption amount or paying any gift tax. And so if you have 3 kids, you can gift $18,000 to each of them. Or, if you have 5 grandkids, you can gift $18,000 to all 5 of your grandkids. And you can do that every year. And so what a lot of people do is they just make consistent annual gifts. They use up their $18,000 in 2024, and they make another gift in 2025. And so if you keep doing this consistently, you can transfer a lot of wealth that way.
Yeah. Just to kind of like summarize that. So you have your lifetime exclusion, which currently per individual is roughly 14 million. In a little over a year, in 13 months, it'll go down to 7 million. Now, in addition to that, you receive this annual exclusion. And the kind of interesting part is your lifetime exemption is total that you get to give. Your annual exclusion is a amount per year per individual that you gift to. So in some sense, if you had 1 million grandkids, right, like you essentially have 18,000 times 1 million grandkids, right? Like obviously that's kind of far-fetched, but the idea is there's theoretically no limit. It's the number of people that you want to gift to versus your lifetime exemption is a fixed amount per person, right?
Yeah.
Now, to that piece of, kind of the basics of, okay, so you have lifetime exemption. Let's start with kind of like how you optimize this annual exclusion. I guess somewhat simply is you have $18,000 in 2024 that it's use it or lose it. Is that kind of fair to say?
Yeah. So the reason this is a key thing, a key end of year estate tax thing, probably maybe the biggest is it resets every January 1st. So if you're going to use your 2024 exemption, you have a little over 3 weeks to do it. I guess 4 weeks, because that $18,000 per person is going to disappear at the end of this year, and then you'll have a new one for 2025, but you'll never be able to get back the 2024 annual exclusion amounts.
Yes.
I
was gonna say, it's like simply put, it's like obvious question is like, what's the value of this? Let's say you have 2 kids. Each of your kids has 2 kids themselves. Let's say you're 18,000. You're married, so you can give between you and your spouse. You can give 36,000. You can give that 36,000 to each of 2 kids and 4 grandkids to 6 people, right? And so, kind of rough math, it's a little over 200,000 that you can give this year to those folks, gift and estate tax free, right, Peter?
Yeah. And so if you think about it, if you do that every year for 20 years, and you're also getting investment returns on that $200,000 or whatever, that's going to be several $1 million in 20 years. So you might think $18,000, not that much, but it really does add up over time, especially if you have multiple beneficiaries.
Yeah, there's 2 like really important piece there. So that 18,000 you give, it's not taxable according to the kind of gift tax. It doesn't count towards your lifetime exemption, so you still have that full 14 million or 7 million in a year, in 13 months. So you don't face that. You don't use up any of your lifetime gift exemption. And then another piece that I just want to draw out that Peter mentioned is you gift that 18,000 or 200,000 between 2 kids, 4 grandkids. The growth on that happens outside of your estate, and so it doesn't face the gift and estate tax. Hoping everyone here kind of understands the value of compounding and growth. And so this is where, that 200,000, it doubles in 7 years. And all of that is gift and estate tax free and doesn't use up your lifetime exemption.
Yeah, and the other thing is, I don't know if this is his question, but he might be asking about income tax. And so in general, any gift you make to somebody is not income taxable to them. There's an exclusion under the tax code. Basically, gifts are not income for income tax purposes. And so, if you gift $18,000 to your kid or whatever, they're not reporting that on their income tax return either.
Yeah. So okay. Good that you saw that. It's not income tax on them as well. So piece here is use it or lose it if you're worried about the gift and estate tax. Now, one of the most common ways to use this is Crummey Trust. Do you want to give just kind of a brief overview of what a Crummey Trust is, kind of the key benefits?
Yeah. So Crummey Trust it's basically a pretty simple trust. It's designed to receive these annual exclusion gifts. Basically the way it works is you set up a trust. You can set one up through Valur, but you set up a trust The trust is for your son, daughter, grandchild, whoever it is, and you gift the annual exclusion amount to the trust each year. Most trusts don't qualify for the annual exclusion, but these trusts are specially drafted so that they do. So why would you use a Crummey trust instead of just gifting money outright? And there's a few reasons. One reason is that you might not want your child having that or grandchild having that money themselves, because maybe they're too young or they're immature. And so by using a trust, you can name a trustee, and the trustee can make sure that the money isn't squandered. Another reason to do it is maybe you do trust your kid, but you're worried about creditors. So trusts are generally very creditor protected. Crummey trusts are also creditor protected. And so, if you give money to your kid outright and the kid gets sued or divorced, that money could go to creditors or divorcing spouses. If you give the money to Crummey trust, that's pretty shielded from creditors. And so the creditors aren't going to be able to get that money. So that's another benefit. And then the third benefit, which is a little bit more abstract, it's sort of an estate tax benefit, which is that you can actually pay the taxes that the Crummey trust generate. You can pay those taxes yourselves. And, you might think, oh, well, I don't want to pay additional tax. But it's actually this great gift and estate tax benefit, because every time you pay the trust taxes, it's like you're paying your kids taxes, but it doesn't count as a gift because of the way the tax rules work. It's not considered a gift for gift tax purposes. And so, if you keep funding a Crummey trust every year, eventually there'll be like $1 million in the trust, and it'll be generating a decent amount of tax liability each year. And so eventually, actually, your tax payments on behalf of the trust will actually be larger than your Crummey gifts.
Yeah, and this is like it's almost hard to kind of explain of how important this is. But really, the easiest way to think about it is everyone here pays taxes. Everyone here also knows that your wealth would be a lot higher if you didn't pay taxes. And by you paying your kids' income taxes or their Crummey trust income taxes, one, it lowers the size of your estate. So what that means is if you're over that lifetime gift exemption, it means you can lower the size of your estate so you can avoid gift or estate taxes. But also it means your kids' assets grow income tax free. And so it's in some sense, it's their trust assets get to grow tax free, which means they're going to have a lot more wealth, and you're reducing the potential size of your gift and estate tax. And this, if you fund this for a long period of time, or it can be worth millions, tens of millions or more over life. And it is one of the most powerful kind of estate tax mitigation strategies. We'll kind of there's a question here from Michelle of, can you name Valur as a trustee if the trust is prepared by another attorney? Yes, in most cases, we do like to review that. And just a little bit of, should have mentioned this up front. Generally, Valur helps people. We help people prepare the trust for no cost up front. And then we also do education, one-on-one calls. We have tools, calculators to help understand these structures. We do all of that at no cost, help you prepare the trust at no cost. And then we do the trust administration. And we're typically 20 to 30% the cost of competitors. Big part of this is we leverage technology to automate a lot of this, kind of just where our foundations are. But the answer is yes, in most cases. We just want to review the trust document, but we also can help you create the trust document for free. We'll go on to kind of the second kind of key tip to use is plan to use your lifetime exemption. We've talked a little bit about this of one, it's about 14 million. It's tied to inflation, so it increases a bit every year. Next year, it'll be 13.99 million. And then Peter, do you want to give context on why it's dropping and what may change that?
Yeah. So in 2017, December 2017, Congress passed the initial Trump tax cut, but for sort of budget rule reasons, it was temporary, and so now it's expiring at the end of 2025. Not just the estate tax changes, also the a bunch of individual income tax changes, and so Congress is going to try to tackle this in 2025. But if they don't pass legislation, or if they pass tax legislation, but it doesn't extend the current exemption amount, it'll revert back to what it would have been without the 2017 tax cut, which would be basically about a $7.15 million individual lifetime exemption amount instead of the current almost $14 million exemption amount. And so, it's important for a few reasons, but the basic idea is that you might only have a year left to use your exemption. And so it makes sense to think about ways that you might use it in the next year. And then the other piece of this is because it increases the exemption amount increases every year with inflation. And so even if it is extended in 2026, it's probably a good idea to think about how you can use the additional exemption that you're getting this year, as well as just in general any exemption that you haven't already used, because it's always better to make gifts sooner rather than later in order to get assets out of your estate if you think that you're going to have a significant gift and estate tax issue.
And just to hit on that point, general assumption, by the way, if you're worried about the gift and estate tax, you're probably fairly good at investing your assets and creating wealth there, or just putting it in the market and it grows over time. Simple kind of answer is if you have assets worth $1 million this year, let's say it grows 10% and it's worth $1.1 million next year. If you gifted it this year, you may have used $1 million of your lifetime gift exemption. We're not going to assume discounting or your annual exclusion, but if you waited till next year, you'd use 1.1 million. And the growth of assets, hopefully in most of your scenarios, is faster than inflation. And so if your assets are growing, the value of your assets grows faster than inflation, to Peter's point, it's better to gift it today and have it grow outside of your estate and use up less of your lifetime exemption and annual exclusion.
Yeah, and so and the slide says what are ways to use your exemption or the additional inflation adjustment, as the case may be. So the obvious thing would be to gift to new or existing irrevocable trusts that you've set up, and it's generally a lot more estate tax efficient to use irrevocable trusts, and it's also much more creditor protected to use irrevocable trusts. So that's a attractive strategy, and Valur can help with that. Actually, we create, I think we have now eight different irrevocable trust products. So we can help with a lot of different strategies. And I don't know, Mani, if you want to expand on that.
Yeah, and I was just going to say, just as a context, we're not going to get into all of those. We'll talk about some of them today. Just this is a free tool we have on our site. It's kind of our comparison calculator, and what you can kind of really do is you can choose assumptions of we have this for estate tax. We're rolling out capital gains later this week, and then the next couple of weeks ordinary income. It's really for all the kind of best practice applicable solutions for that given tax. You can kind of choose which ones you're looking at, read more about them, input your data, scenarios, what you're worth, kind of growth assumptions, and you can actually run this to see what is the value of these different trusts, what does the ROI look like, compare these things, look like over time, and really be able to understand what do these numbers look like and their trade-offs and benefits. And part of this is one, help you understand that. We're also happy to chat with you, but it is a piece of, there's a lot of different strategies. Each of them have kind of a slightly different use case. And it's helpful, I think, whether you work with us or not, just understand what are the options, what are the trade-offs and benefits, and what's the end value to you and your family. But to go back to kind of this, that's kind of like, and this is the point is, Peter's talking about, you want to gift your lifetime exemption to irrevocable trusts. These 8 different ones they all have different sets of trade-offs and benefits and best practice use cases. And so part of it's figuring out, hey, if you're watching this, you're probably worried about the gift or estate tax for you or your family or your clients. And it's understanding which of these vehicles and it may be multiple vehicles, is kind of the best fit for the problem you're solving. Is that fair to say?
Yeah.
So that's kind of one piece is, if you use that exemption, use inflation, use it before it drops, unless legislation passes. But anyways, it's worth doing earlier versus later. Now, do you want to explain just the basics of discounting of like if you're gifting assets, which
Yeah.
ones should you choose?
Yeah. So the basic idea, so, let's say you gift an interest in an LLC, like a 20% interest in an LLC that owns some sort of illiquid asset. Um, that's not going to be valued at 20% of the asset value. It's going to be valued at less than that, probably about a 35% discount relative to the asset's fair market value. And the reason is there's a few reasons, but the basic idea is that nobody who's sort of like a third party buyer would want to pay 20% of the value of an asset in order to buy a 20% interest in an LLC that owns that asset, because they wouldn't have control over the asset. There wouldn't be a liquid market to sell their 20% LLC interest on. And so you're going to have to get some sort of valuation discount on that amount. Whereas if you transferred Google shares, that's not going to get a discount really, because Google shares are traded on stock market at fair market values, and so there's no lack of liquidity, there's no lack of control issue, so it's not going to generate a discount at all. So in general, with anytime you're making a gift and you're using some of your gift tax exemption amount, you want to try to give things that are illiquid, because those are going to generally get these large valuation discounts that effectively allow you to transfer 35% more or so than you otherwise would be able to transfer.
If another way to frame this, if you have an illiquid asset, you're able to take more of a discount, so you use up less of your annual exclusion or lifetime gift exemption.
Yeah.
So you'd rather gift illiquid assets versus liquid assets. The harder it is to ascertain the value of something, the more the advantages it is to you to gift if you're worried about the gift and estate tax. Now, question from Derek here it's a good question do Crummey trust assets get a step up in basis?
And the answer is that they don't, but there's sort of a caveat. So any trust that's outside of your estate for estate tax purposes, which Crummey trusts have to be in order to get assets out of your estate, any trust that's outside of your estate is not going to get a basis step up when you die. But what you can do is you can actually swap highly appreciated assets out of the trust during your lifetime before you pass away. And that mitigates a lot of the basis step up issue. So let's say that you've been contributing assets to the Crummey Trust for 30 years, and now there's $5 million of assets in the trust, and the basis is $1 million. So it's really low basis. You're not going to get a step up on that $5 million asset when you die. But what you can do is you can swap, let's say, $5 million of cash or another high basis asset into the trust, free of any tax consequences, no gift tax consequences, no income tax consequences. You can actually swap those high basis assets into the trust. Meanwhile, you'll get that $5 million of low basis stock back into your name personally. And so if you die the next day, you'll get a basis step up, or your heirs will get a basis step up in that stock. And meanwhile, the stuff in the trust won't get a basis step up. But if it's already high basis, then you won't need the basis step up, so it won't be a loss to you.
Yeah. So another summary is, so the answer is no for Crummey Trust, but there's also swaps and things that you can do to, even if you put in low basis assets, that you could swap it out over time and get the low basis assets back in your name, even if you've gifted it, correct?
Yeah.
Peter?
Yeah.
So the answer is no, but even if you do that, there's ways to get it back into your estate to get step up if you're worried about that. One quick question before we move to the next slide. Talk about how using Crummey Trust at Valur works. Peter, do you want to start with there's a second part of this question so the custodian, we typically use Schwab. Valur is not a custodian. We don't custody the assets. We use third-party custodians. So we don't control that piece. Typically at Schwab, we do work with some other partners, or if there's someone else you have in mind, you can let us know and we can see if we can work with them. We've worked with Morgan Stanley, Goldman, etc. as well. The second part of the question, can a spouse be the trustee of a trust the other spouse is a grantor of? And the short answer is maybe.
The short answer is yes. Yeah.
Okay. It depends on the trust, but yes. We can, and this is where if you're curious about for a particular type of thing, let us know and we can set that up. One other quick thing. Question, are these trusts South Dakota based? As a default for most estate planning trusts, the answer is yes. There are some scenarios where, going to the previous question from Jim, if you want your spouse to be the trustee and they're located in another state, then there's no downside to that, or not a significant downside. We can also do that. But as a default, if you're using Valur, they are South Dakota based. Just move on, because we're running a little slow. So freezing GRATs to lock and gains. I'll give a quick kind of overview of GRATs. GRATs are this really unique kind of powerful structure. Essentially every kind of wealthy family has used GRATs. This is from the Walton family behind Walmart. They've used them. They've actually used GRATs in such a unique, prolific manner that the IRS sued them. They fought it, went to the Supreme Court, and the Supreme Court ruled in favor of the Waltons, and the IRS lost. Phil Knight, founder of Nike, also uses this. GRATs, essentially the idea is you can pass on assets to future generations or trust for kids, future generations to benefit from that doesn't use your lifetime gift exemption or annual exclusion. Wondering how does that work? Short answer is you contribute assets to a GRAT and they get valued on the date you contribute them. The IRS essentially says GRAT stands for grantor retained annuity payment. Key parts that matter is the annuity piece. Every year you get an annuity payment from a GRAT. And effectively what happens is you have to pay yourself back the principal plus an interest rate that's determined by the government, typically somewhere in the 2 to 5% range, right, Peter?
Yeah.
And so you essentially have to pay yourself back principal plus that interest rate. Let's just say it's 3%. And any growth the asset has above that interest rate gets passed on to your heirs or their trust, gift and estate tax free without using your lifetime exemption. I miss anything kind of basic there?
Yeah, exactly.
So let's talk about let's take this scenario. As a default, and we're not going to go deep into this, you typically set up a 2-year GRAT for an individual. And so let's take this scenario and we'll change details, but someone we're working with now, they set up a GRAT roughly a year ago. They contributed a good amount of crypto to it. It's up a significant amount. For simplicity's sake, let's say it's doubled, right, Peter? It's a 2-year GRAT. So they're 1 year away from their GRAT being finished and passing on assets to their kids. Let's say, for example's sake, they put in $1 million, it's worth $2 million. Like, what is the reason to freeze the GRAT to lock in their gains?
Yeah, so the idea is, say the asset in the GRAT is highly appreciated. You can either let the GRAT ride it out for the rest of the term until it ends, and hope that the assets keep going up or at least don't drop, or you can sort of be proactive and swap out that appreciated asset at that higher value and guarantee that the GRAT beats that 3% hurdle rate or whatever it is, as Monty mentioned.
And just to make this clear, essentially what's happening is you're giving and I'm using air quotes here, you're giving a loan to your own GRAT. And by the way, there's not really money changing hands because the GRAT is still considered in your estate. But what you're doing is take, $1 million of Bitcoin that you put in a GRAT that's now worth $2 million. You could keep that $2 million in the GRAT and hope in a year it's still worth $2 million or more, so that a little under $1 million passes on to your heirs, gift and estate tax free. Or you could give a loan, essentially a note payable from yourself to the GRAT for $2 million at the government's interest rate. Let's just say it's 3%. And so you now know that a year from now when the GRAT ends, that GRAT will be worth $2 million. So what you've done is you've hedged out the volatility of Bitcoin prices going up or down, and you've locked in what will be left for your heirs. Is that kind of an accurate description, Peter?
Yeah.
And that's kind of like, it's really a hedging mechanic, right? You're giving it upside and downside, but you're locking in your gains, and no cash is really moving hands. Yeah. Perfect. And the reasons to do this, one is better to lock in gains, and also markets are fairly high. Crypto markets, equity markets, things are in those areas are pretty good. So there's an opportunity to lock in your gains. And by the way, there's no real downside because when you swap out, in this example, Bitcoin, you could just take that Bitcoin and put it into another GRAT. So you can lock in the gains in this and put it into the next GRAT so that if it goes up, the next GRAT will be able to capture that upside. But if it went down, the first GRAT is already locked in its gains. And the second one, that means that it's not going to impact this. We'll go kind of, so that's kind of one big piece. And this is where it's fortunate you can, just have to do this before the end of the year, of transfer the assets or swap it to take advantage of it. Gifts to CLATs. You want to give a kind of just a quick description of what CLATs are?
Yeah, so a CLAT is essentially the same thing as a GRAT. The only difference is instead of making the annuity payments to you, you make the annuity payments to a charity. And so the idea is, you set up a CLAT for a certain number of years. You pay a charity annuity payments until the end of the term. When the term ends, whatever's left over passes to either you or more often your children. And so it's a way to both support charity and also transfer assets to your beneficiaries free of gift and estate tax. And so one of the benefits is, unlike a GRAT, this is a charitable vehicle. And so you are making charitable gifts, which means you get a large upfront charitable deduction, assuming it's what's called a grantor CLAT, which is what most CLATs are. And so you get this large upfront charitable deduction. And so if you're thinking about doing a CLAT, typically people do them before the end of the year so that they can get a 2024 deduction if you're worried about 2024 taxes. So it's sort of a little bit of a time pressure thing for people doing sort of December tax planning.
Yeah. And so again, 3 key benefits here is you get a charitable deduction that can offset already realized income. The annuity payments will go to a charity. It could be your family foundation, your own donor advised fund, and the remainder, what's left after the annuity payments, can go on to your kids. And there's kind of 3 pieces. Is one other thing is similar to Crummey Trust, you pay the income taxes or capital gain taxes on the income realized within the CLAT in most scenarios. And so you can actually, again, you can burn down the size of your estate. So you reduce further future gift and estate taxes. Don't use up any of your lifetime gift exemption for the remainder that passes on to kids. And you get to give to a charity for people that want to gift. There's a couple of questions here. So can you use the AFR, FFR for interest rates? This applies to GRATs and CLATs. Peter, you want to?
Yeah. So basically it's called the 75/20 rate. Both GRATs and CLATs use it. So it's based on the midterm AFR. It's actually 1.2 times the midterm AFR. And so right now it's around 5%. Fluctuates over time depending on what the AFR is. The AFR is the applicable federal rate. For those who don't know, it's an IRS interest rate. It's usually around 3%. It's been a little bit higher the last few years just because of interest rates being higher in general. But it's usually around 3%, 2.5%, 3%. So yeah.
Another question, I'll take this one from Satish, is, are CLATs required to donate a certain percentage of their assets every year? So it's a really good question. There's actually 2 types of CLAT. Stands for charitable lead annuity trust. There's also charitable lead unit trust, or CLUT. A lot of acronyms, AFR, this. So it's kind of unfortunately a nature of the space. But so a CLAT has to donate a fixed amount every year, a fixed dollar amount. Charitable lead unit trust, CLUT, has to donate a percentage every year. We won't go into depth why. Effectively, CLATs tend to be much higher ROI for individuals. Simple reason is because you can grow your assets faster than interest rates in most cases. If you believe you can invest assets faster than kind of the 75/20 rate or AFR, you generally want to do a CLAT. If you're choosing between a CLAT and a CLUT. If you're choosing between a charitable remainder unit trust, CRUTs or CRATs, there's that same distinction. You want to choose a CRUT and it's really just based on, do you believe you can beat the 75/20 rate for investment growth? So we'll move kind of on to here. Now, making distributions from non-grantor trust. And Peter, I guess, and I'll start with this, the short thing of a non-grantor trust is it's an irrevocable trust.
Yeah.
Earlier, we as a default base these in South Dakota for tax asset protection reasons, but it's its own tax entity for income taxes and gifts and estate tax purposes, right, Peter?
Yeah.
And
So it's a separate taxpayer, and so it files its own income tax returns. So one of the neat things about a non-grantor trust, which is what a lot of irrevocable trusts are, is that so in general they pay their own taxes, but they get a deduction every time they make a distribution to a beneficiary, and then the beneficiary pays that portion of the taxes. So let's say the trust has $100,000 of income in 2024. The trust can pay the tax on $100,000 itself, or it can distribute some or all of that money to beneficiaries. And if it does that, then it'll get a deduction for the distribution, and then the beneficiary will go to K1 reporting that income on their personal returns. And so this creates a lot of sort of strategy around whether you want to keep the money inside of the trust for the trust to pay taxes, or whether it makes more sense to make a distribution to the beneficiary so that the beneficiary can pay the taxes. One thing about non-grantor trusts is that for federal tax purposes, they're mostly taxed in the top 37% tax rate, tax bracket, because the tax brackets for trusts are really compressed. And so if you have a trust that's in the 37% tax bracket for federal taxes, and you have a beneficiary who's just out of college and they're not earning very much money, they might be in a much lower tax bracket than the trust. And so you might think, the trust is paying 37%, Jimmy's paying 10%, so maybe I should distribute some of this income to Jimmy so that he'll pay a lot less in federal income taxes.
I guess another way to really frame this is, so these non-grantor trusts hit their top tax bracket, the top tax bracket of 37% at the federal level at $15,000, versus it's obviously significantly higher for an individual. And so really what you can do is you can optimize, who do you want to pay the tax?
Yeah.
The trust or you? Let's say you're a high income individual, you have a high salary or high income. There's no real advantage to having the trust distribute the money to you unless you need the money, because the trust has asset protection, creditor advantages that you don't have. So you'd rather keep it there. But let's say, to Peter's example, let's say it's for your kid. Your kid's in college, doesn't have much income. Your kid might be paying 20% tax rate. And so then in that case, from a tax perspective, it may be more beneficial to distribute that money to your kid, because they may pay a lower tax rate than the trust. But they won't have the asset protection, credit advantages. But if they're going to spend that money, pay for college, rent, those types of things, then that may make more sense. So this is one of those things at the end of the year, just considering who the beneficiaries are, what the expected tax rates are, and figuring out, do they need the money? Does it make sense to distribute?
Yeah. And so December is a good time to think about this if you have a non-grantor trust. One of the unique things about it is that you actually have a 65-day grace period after the end of the year. And so you can theoretically make a distribution in February and basically elect for that to be treated as a 2024 distribution, even though it was made in 2025. And so you actually have a little bit of time after December 31st to figure everything out. But it's a good idea to try to figure things out as much as possible before the end of the year.
Yeah. Now, loose ends, things that this is really of if you've kind of already done stuff. So one thing is, if you gift money to a Crummey trust, to a GRAT, to a non-grantor trust, all these different trusts we've talked about, you need to prepare a gift tax form. Now, just quick, if you've done that with Valur, we take care of the gift tax form at no cost. We've automated that, so it's fairly straightforward. But if you haven't, or you've gifted to kids, trust for kids, you need to make sure that you inform your tax preparer about that and you get the gift tax form done. We can also, if you don't work with us, we can take care of that for you. There's a cost as well, but that is something that you do need to do. Peter, you mentioned kind of formula bequests. What is that?
Well, I think it might make sense to see if anyone else has questions before I get into. I want to make sure we're able to answer people's questions before we end this webinar.
Yeah, I mean, let's just. Do you just want to give the kind of the 1 minute
Yeah.
on that?
Yeah.
And we'll go
So,
through
so a
questions.
formula bequest is, so oftentimes in your will or revocable trust, you'll have language, especially if you're sort of more higher net worth, there'll be language that says, when you die, sort of like, X amount passes to your children or X amount passes to your spouse. And oftentimes the formula is based on, the gift and estate tax exemption in the year when you die. And so one of the things that's happened over the last few years is that the, gift and estate tax exemption has increased dramatically. And so, and it keeps increasing, at least for now, with inflation. So, it's a good idea to, sort of review your will or revocable trust to see if you have one of those formula clauses. And if you do, whether it still makes sense. If it was drafted in 2016, when the gift and estate tax exemption was like 5.5 million, now the gift and estate tax exemption is going to be about 14 million in January. And so, that $5 million bequest is now a $14 million bequest. So it might make sense to sort of reevaluate, some of that language.
Perfect. And then to these other pieces is where GRATs or CLATs where you have to, or insurance premiums where you have an annual payment, making sure that those are done. Now, just to kind of want to leave some time for Q&A. So one piece is if you have questions on this, you can set up time with us to chat. You can email us directly. Another thing is we've gotten some kind of DMs. So I'll just quickly, if you don't know where to get started, one, feel free to reach out to us. You can also, we have these tools like, again, all of this stuff is free, this guided planner. If you're not even sure where to get started, just start with this of what taxes or problems are you solving with. You can kind of go through this to just answer basic questions of have you realized it, have you not, what type of asset is it, and really start to get to kind of like what are opportunities you have to reduce those taxes. And then you can start to kind of compare these things, and you can even from there jump to we also have calculators where you can actually see the ROI of very specific structures, dive into liquidity, things like that as a starting point, decide if this is worthwhile for you. So everything from all the structures we've mentioned, you can look at ROIs on an individual structure basis or compare them. Or you can schedule time with us to better understand it. We also have content, articles, videos to help explain this. For the next 2 weeks, we'll also have kind of end of year planning for capital gains and ordinary income taxes. So if those are things, reach out to us or join those webinars. But we'd love to leave some time for any questions that anyone else has. But if not, really appreciate everyone taking the time to join. Know the end of the year can be busy between family, travel, and closing end of year work stuff. So we'll leave another minute for questions, but we know we ran over. But really appreciate all the thoughtful questions and time that everyone took today. All right. I think we hit on all the. I think we hit on all those questions and appreciate the positive feedback from everyone. And also, please let us know if there's topics that you would want to hear us talk about or anything we can do better. But thanks again for joining, everyone, and looking forward to hopefully seeing most of you next week.